Welcome in. You're listening to the weekend edition of the Corlin Economics Report, and I'm Al Corlin. Appreciate you joining me. This audio is being recorded at the Cambridge House World Investment Conference, which is held in Vancouver, British Columbia, twice a year. Joe Martin, Howard Finch, and the guys do a great job. Big Al thinks that this is perhaps one of the best venues, if not the best educational venue in the world when it comes to learning about resource companies. We only have one mic here, so I'm going to have to pass the microphone, and least he starts throwing things at me because I'm not giving him enough attention. I'm going to start out with the best geologist in the world, Mickey Fulp. And Mickey, if you could just introduce yourself, tell us about your newsletter, and then hand the mic over to Lawrence, if you would.
I'm Mickey Fulp. I'm the Mercenary Geologist. I run a website called www.mercenarygeologist.com. I write a newsletter. I do quite a lot of audio and video, and my newsletter addresses a variety of subjects: macroeconomics, commodities, libertarianism, geopolitics, and I also cover my favorite stocks in the junior resource sector.
My name is Lawrence Rolston. I write, edit and publish a newsletter called Resource Opportunities. Our focus is on developing companies within the metals space. We look at precious metals, that is gold, silver, platinum, palladium, but also base metals, uranium, rare earths, and other specialty metals. But the focus is on companies, and we're not following sectors or commodities, but we're really looking for companies.
Don't mean to cut you off. Some people in the back are having trouble hearing. Is it a volume problem? Lawrence, if you could just put the mic closer to your mouth, that would be great. And then speak up. We do have a volume issue in here. Thanks, man. Go ahead. You done? Yeah. Oh, okay, go ahead.
My name is Roger Wiegand. I'm editor of Trader Tracks. My partner is Jay Taylor. My newsletter comes out once a week on Friday night by email. We do futures and commodities trading recommendations. We recommend mining shares, junior, senior, and others. And our letter's been in business now about 7 years. We've got a good trading record. We think that with the volatility coming up, things are going to become more exciting and more interesting in the markets that we follow. So we encourage everybody to get involved.
Roger, the two gorgeous women sitting, the two blonde ladies, are laughing at either you or me, and they're probably laughing at you because you've got hair, right? Keith Schaefer. Keith is a new guest on our program, was introduced to me by a good friend, Nicola, up here in Vancouver probably about a month ago. He's got a newsletter. Let's hear about that one.
Thank you, Al. My newsletter is called the Oil and Gas Investments Bulletin, where I cover, in my paid subscription service, the fastest growing junior and intermediate growth stories I can find in energy, both oil and gas. And then I also have a public blog at www.oilandgas-investments.com, where I write about general industry issues.
And then very definitely the new kid on the block. He just started a newsletter last week, Eric Coffin.
Yeah, my newsletter is called Where the Hell's My Brother?
No, your brother never shows up, so it doesn't matter. Tell us about the newsletter. Tell us about your background. Tell us about what you did last summer, man.
Okay.
Can you hold the microphone? My hand's getting...
Fine, whatever. Hi, Eric Coffin, my brother and I publish a news service called the HRA Advisory, Hard Rock Analyst. We've been publishing since '95. We basically specialize in resource stocks. We tend to stay on the junior side of things, although we do follow companies through to production and pretty much across the metals and some of the bulk materials.
Okay, I've got some questions for these guys. Anybody in the audience have any specific questions they might want to ask? I'm going to start out while you're thinking about it then, and the question I would start out with is an issue that I received some emails towards the end of this past week from listeners concerning the following. Peter Grandich and I were chatting on Kitco audio that I do, and he was saying that he feels the stock market, the conventional stock market, is going to absolutely collapse. But in spite of that, he feels that resource stocks are a good place to be. Okay, I would agree 100%. My listener, however, said, how can the resource stock market maintain or go up or appreciate, I guess I should say, in value when the conventional market at the same time goes down. Who wants to tackle that one? Keith?
I think you're both right, Al, in the sense that your subscriber, if things really do go as far south as quickly as he says, commodities are absolutely going to be dragged down with it. But what we also saw at the end of 2008 was that the most two prolific bounces were in oil and gold, which would make our resource market one of the best places to be should that happen.
Anybody want to add to that? Lawrence, what do you think? Up close and yell, buddy.
I think it's really important to differentiate between what so many people in the United States in particular call the stock market with what's happening in the rest of the world. The American companies, especially those companies within the United States that are totally focused within the United States, are having a really tough time of it, and they will have a tough time of it for some time yet. But the other parts of the world, in particular Asia, are going through a phenomenal growth period right now. And commodities are global. Commodities are priced in world terms. So, you know, while the U.S. and Europe are still struggling to get out of a recession, the copper prices bounced back from the low after the global financial crisis. It went down to 125. It was back up to 350 before the Greek thing brought it back to the $3 level. That's just an example of commodities responding to the world scene and not just being a reflection of what's happening in the United States. And in particular, the emerging countries are having a much bigger impact on commodities than the United States is. The mature economies are not nearly as intense users of metals as are the emerging developing countries like China and India that use a lot more metal per unit of economic output than a mature economy does. So we're seeing tremendous strength in the commodity prices, and that is pointing to ongoing strength in the companies themselves, in spite of what might happen to the American economy, which so many people refer to as the economy, like it's the only part of the world economy.
Mick, before I give you the mic, Roger, you're the guy who started this whole thing. You're convinced that the markets are going to experience a major correction, and you're talking before the end of June. I think that's very possible. But how would you address, our listeners' question?
This has been a dilemma for us to figure out if the mining stocks are going to cave in with the rest of the pile. We think they will sell off somewhat, but we don't think now that they will sell to the degree that we appreciated before. I think that a small correction is inevitable when the big stock markets, the general mainstream markets, do in fact sell, which we're expecting between June 15th and end of July. Many of my analyst friends are saying that this spring crash is going to be a nasty one. We don't think it's going to be very pretty, but the more I look at it technically and in other ways, I think that it's not going to be as bad as I originally expected. I think that you'll see the Dow go down from its current number of 99.32 this morning on Sunday down to probably maybe 88.50, 8,500, and then come back. But all the stocks are going to sell briefly, but the important key point here is this. The U.S. dollar was rising and gold was rising here about a month or two ago. It's never done that in 10 years. And that is a signal to me that the gold and silver community and the investors related to it are not paying as much attention to the U.S. dollar. They don't care where it goes. They know that for the near term, the longer term, they better stay invested in gold, silver, and the related stocks simply because that's going to be the last bastion of safety and security. So there's going to be a stock selling event, we think, in June, July, probably a worse one in October. I'm thinking now that the one in October, November is going to be much worse than the one in the spring. The last time we went to 66, I think maybe next time by the end of the year, we go to 5,600. Some are saying 4,600, but I think below 56 we could easily go to 3,000. But the point being this, you can buy the junior and intermediate gold and silver stocks with some security and safety if you're in the right ones, knowing that you're going to get a haircut coming up. If you don't own them yet, I would wait until you see what happens. If you own them now and you got a lot of profit, you can take it. You can sell half, keep half, or you can keep it all, and on the ones where you can get options, you can get put options on certain other stocks to protect yourself. So there's ways to work your way around the issue.